why your bank account isn't actually yours. The 1933 proof begins not with a conspiracy theory, not with a hidden clause, but with a signature that every citizen was forced to obey without ever truly understanding what they had just lost. You believe that when you deposit money, it remains yours. You believe that numbers on a screen represent your freedom, your work, your safety. But in 1933, in a single presidential order, the United States government made it clear that ownership was a privilege, not a right, and that banks were never mere financial warehouses. They were custody prisons for wealth, with escape doors welded shut. Everyone thinks their bank account is personal property. It feels personal because your name is on the ledger. Your salary enters it. Your bills leave it, and your life depends on it. But history shows that names don't equal ownership, and 1933 is the proof. That was the year money stopped being a shield and became a lease. That was the year the United States made it illegal for citizens to hold the very thing that defined wealth for thousands of years, gold. The government didn't ask, it didn't debate, it didn't negotiate, it commanded, turn over your wealth, or become a criminal. Before that moment, banking still carried an illusion of autonomy. Depositors believed they stored value the way one stores a family heirloom, safe, untouched by political mood or national crisis. Gold backed the dollar, gold represented independence, and gold marked the difference between citizen and subject. But the Great Depression shattered confidence like a glass dropped onto stone. Banks failed, runs began, and panic made a silent truth impossible to hide. The banks had never kept enough. The promise of redemption was a mathematical lie. More paper existed than metal. More IOUs than units. More claims than reality could support. The government had two choices: admit collapse or seize control. It chose control. Executive Order 6102 made private gold illegal, forcing people to surrender their wealth at a mandated price. Imagine the scene: a lifetime of savings, coins kept in drawers and safes, family inheritance passed from father to son, suddenly labeled contraband. It was not theft by gun, it was confiscation by law, and the banks became the intermediary. Citizens turned in gold through banks. Banks turned it over to the government. And just like that, the chain of ownership snapped. The gold was not secretly stolen, it was openly absorbed. And what followed was even more revealing. Once the gold had been handed over, the government revalued it at a higher price, giving itself profit and leaving the public with the scraps. That moment is the clearest proof that banking has never been neutral. Deposits aren't stored. They are loaned, multiplied, leveraged, pledged, repackaged. And if you attempt to withdraw too much at once, you don't expose the bank. You expose the system. Cause and effect became brutally obvious. When banks failed, deposits vanished. When deposits vanished, trust collapsed. When trust collapsed, the government stepped in not to return control to the people, but to harden its own. The Federal Reserve strengthened, emergency powers expanded, and the modern citizen inherited a world where holding wealth outside the system became suspicious, even dangerous. The shift wasn't temporary, it became permanent policy. Once the state claims authority over money, it doesn't return it. Once ownership converts to permission, permission becomes the only language a citizen can use. Those who believed 1933 was a one-time emergency misunderstood patterns. Power never reverses, it evolves. In 1971, the final connection between money and reality was severed when the gold window closed. Now, money wasn't backed by anything except promise, and promises, as history shows, can be rewritten. Today, when you deposit your money, legal terms classify it not as property you store, but as a loan you give to the bank. Your money becomes their liability. Your account becomes their asset. And in every contract, in every banking clause, one phrase repeats: subject to availability, which means your money is not guaranteed to you. Bank holidays, bail-ins, withdrawal limits, emergency powers, these are not fictional doomsday concepts. They have already happened. They have precedents. They have language. The same emergency justification used in 1933 echoes now in softer vocabulary. Banking stability, liquidity requirements, deposit insurance, all designed to make you feel secure inside a structure built on scarcity and supervision. If ownership were real, you could withdraw everything at once. But if everyone withdrew at once, the system would collapse because the system was never built on one-to-one reality. Look around today. Digital currency rises, physical cash shrinks, and centralized control intensifies. Every transaction leaves trace, every ledger entry monitored. What was once stored in a vault you could touch is now numbers floating in a server you will never see. The shift is not accidental. It is architectural. The further money moves from physical reality, the easier it becomes to regulate without resistance. In 1933, they seized metal. Today, they don't need metal. They only need a button. The pattern has repeated in other countries. Cyprus bail-ins, Greek withdrawal limits, Canadian emergency freezes. Modern people believe such things only happen elsewhere, never here, never to them. But every collapse is preceded by confidence. Every confiscation begins as protection. Every directive is written in language that promises safety while silently transferring control upward. What 1,933 proved is that the bank account was never yours. You were a permitted user, not an owner. The proof sits in historical record, in executive order, in legal code, in deposit classification, in the fact that possession of wealth became a crime when the government decided it was necessary. The system did not apologize. The system did not reverse. It simply evolved into the world you now live in, where you trust numbers that you never touch, guarantees that are not guaranteed, and definitions of ownership that collapse when tested. Three things remain unmistakable. First, history never lies about the nature of power. It only waits for you to notice. Second, the concept of personal financial sovereignty has always been conditional, never absolute. And third, systems built on permission can remove permission without warning. If 1,933 taught anything, it's that wealth inside a custodial system is never truly held, it is borrowed time. So the next time you look at your balance and feel secure, remember, stability is not proof of ownership. It is only proof of silence before another directive. If this opened your eyes, if you want to understand the patterns before the next emergency declares them for you, make sure to subscribe, like the video, and stay here. The past isn't just history, it's a written manual of what happens next.